Chapter 8, Risk and Rates of Return. In Chapter 8, we will discuss risk and return from the standpoint of a single asset, risk and return from the standpoint of a portfolio, and that will lead us into the capital asset price. What is risk and return? Risk is the chance that an unfavorable event may occur. In finance, risk is related to the probability of earning a low or negative actual return. The greater the chance of lower than expected or negative returns, the riskier the investment. Return is the total gain or loss experienced by an investment over a period of time. Investors are what we term risk averse. They dislike risk. They run away from it. They try to avert it. However, they also require higher rates of return to encourage them to hold riskier securities. And that leads us into the risk premium. That's the difference between the return on a risky asset and a riskless asset. And that serves as compensation for investors to hold riskier securities. So, risk and return always go hand in hand. And investors should never make a decision solely based on return. They should also consider risk. And there is a positive relationship between risk and return. The greater the risk of an investment, the higher the return that will be required by investors, since inherently they dislike risk. They are risk averse. The only way that they will take on risk, that they will bear risk, if that investment offers a higher rate of return. So, we are first going to look at risk and return from the standpoint of holding a single asset. So, we assume that an investor holds only one asset. They have invested all of their wealth into that one single asset. So a key part of calculating risk and return for a single asset relates to something from our study of statistics, and that's probability distributions. A probability distribution, as you will probably recall, is a listing of all possible outcomes, and there is an associated probability with each occurrence. When you add together all of those probabilities of each occurrence, you're going to end up with 100%. Before we get into the formula, so here is a table that's replicated from your textbook. It's table 8.1. We have two single assets, Martin Products, U.S. Water. We would put all of our money in one or the other. There are three possible outcomes here: a strong economy, a normal economy, or a weak economy. There's a probability associated with each one: 30%, 40%, and 30% respectively. There is also a rate of return associated with Martin Products under each one of those outcomes. We're going to use the formula from our previous slide and come up with an expected rate of return. It's 10% for Martin Products. We do the same for U.S. Water. So we have two single assets where we would put all of our money in one or the other. expected returns are exactly the same at 10%. But again, we cannot make a decision based solely on return. We have to consider risk. We are going to measure risk for a single asset by calculating its standard deviation. We will take each rate of return, subtract out its expected rate of return, square that difference, multiply times the associated probability of the outcome. We're going to do that for each one of our outcomes. Add them together and then take the square root. So for Martin products, the calculation is carried out here on this slide using the formula from the previous slide. We see the standard deviation is for Martin products 54.22%. That's pretty high. That tells us the variability of those returns. But that's not really a big surprise because we see that those returns can range anywhere from 80% to minus 60% in the probability distribution. For U.S. water, the standard deviation calculation isn't shown here, but it is in your textbook. It is much, much lower. So if we had to choose which one we would put all our money in, Martin Products or U.S. Water, we would obviously choose U.S. Water. Why? Both of these single assets have the same expected return, but the burden of risk, the variability of returns, the chance that some unfavorable event will occur is much lower for U.S. Water. And remember that investors are risk averse. So some observations about standard deviation as a measure of risk for a single asset. Standard deviation measures total or standalone risk. The larger the standard deviation is, the lower the probability that actual returns will be close to expected returns. In other words, the larger the standard deviation, the more risk, the better the chance that you will incur a possible loss. Larger standard deviations are associated with a wider probability of the distribution of returns. Another measure of risk for single assets is called the coefficient of variation, and this standardizes the measure of risk because with coefficient of variation we are finding the burden of risk for each 1% of return. It is risk per unit of return. We calculate it by taking the asset's standard deviation divided by its expected return. When we're presented with a choice between single assets using coefficient of variation, we will choose the asset that has the smallest coefficient of variation. That is the smallest burden of risk for each 1% of return. There are two very good problems that you can find in the video reviews. Problems 8.1 and 8.6 take you through calculating expected return, standard deviation, coefficient of variation for single assets. I would challenge you to try to find the answers on your own. Work the problems on your own, then watch the video reviews.